Thank you. Welcome to the 2021 second quarter update call. This call will include forward-looking statements. These forward-looking statements contain projections of future results of operations or of our financial position or state other forward-looking information. We intend these forward-looking statements to be covered by the safe harbor provisions for forward-looking statements contained in Section 27A of the Securities Act of 1933 and Section 21E of the Securities Exchange Act of 1934. We believe that it is important to communicate our future expectations to investors. However, investors are cautioned not to unduly rely on forward-looking statements, and such statements should not be read as a guarantee of future performance or results. Such statements are subject to risks and uncertainties that could cause actual results to perform or differ materially from those discussed as a result of various factors, including but not limited to risk factors and uncertainties discussed under Item 1A Risk Factors in our annual report on Form 10-K for the fiscal year ending December 31st, 2020, as well as other reports we file from time to time with the SEC. These forward-looking statements speak only as of the day in which the statements are made, and we do not undertake or intend to update any forward-looking statements after this call or as a result of new information. At this point, I would like to turn the call over to Plug Power's CEO, Andy Marsh.
Thank you, Teal, and thank you for everyone for attending our call today. This quarter had a mixture of successes and challenges. The successes were easy to rattle off. Revenue increased dramatically by over 75% versus the prior year. Shipment of GenDrive units to new sites dramatically increased versus the prior year. We closed the HYVIA JV with Renault, targeting the light commercial market for vehicles in Europe. This market is expected to be 500,000 vehicles in 2030, with over 30% of the market captured by the JV. We did have some challenges in the quarter associated with hydrogen costs. There are two major drivers. The cost of ending our relationship with Air Products. This had a short-term impact on pricing and construction costs to replace Air Products liquid tanks. This is about 2/3 of the increase of the hydrogen cost for the quarter. There also was a crisis with the availability of hydrogen due to a force majeure. The force majeure was due to a major hydrogen plant going down for 2 months in the Southeast. This local disruption impacted the U.S. hydrogen network. What I think is really important, we at Plug Power made sure our customers had hydrogen throughout this event. Let me talk briefly about our near and midterm corrective actions. The Air Product changes were a one-time event and now won't be duplicated. We're also now not stranglehold by having industrial gas companies own equipment at any of our customers' sites, giving us greater flexibility in making sure we have cost-effective hydrogen solutions for our customers. Second, the force majeure for hydrogen was an unprecedented event. In July, additional capacity was brought online by our partner Linde, over 30 tons per day, which will alleviate future issues. Just to give people a feel, this is an increase of over 10% of U.S. capacity. We're also increasing our own capacity in October by 3.5 tons in our Tennessee plant. Plug Power will have an additional 70 tons online in the third quarter of 2022, and additional sites online in early 2023. And just to remind folks, we use about 50 tons of hydrogen a day at the moment. And we've already announced additional green hydrogen sites across the board in New York, Pennsylvania, Georgia, and Texas. This week, we broke ground at our Georgia site, and the sites in New York and Texas will be the largest green hydrogen plants in the world. Some may ask, why did we absorb the cost of the force majeure? We believe in the near term, protecting our customers from the challenges in the market today will pay off in the near term. We want our customers to know they can count on hydrogen being available, and more importantly, can count on Plug Power meeting their needs. They will be critical in helping us fill up our new plants. We have exciting news coming up in the coming quarters. We're increasing our gross billing guidance in 2021 to $500 million. This means we'll be increasing our gross billings by over 50% from our 2020 numbers. We will close our JV with SK this quarter, as planned. We're working on the final details of the relationship. Both of us are really quite excited. And we'll also be closing our JV with Acciona in the Iberia Peninsula. We plan to build 30 tons of liquid hydrogen capacity with Acciona, making us one of the largest liquid hydrogen producers in Europe. We're also targeting bookings of 250 to 500 megawatts of electrolyzers in 2021, with 250 megawatts shipping out of our new Gigafactory. We'll be making announcements in the second half for additional takeoff agreements for our hydrogen plants. Finally, and this is really important, with the Gigafactory, we're utilizing state-of-the-art automated equipment in our new manufacturing processes. We're planning to match our unprecedented capabilities in sale and design of fuel cells and electrolyzers, and become not only a leader in manufacturing those devices, but a global manufacturing leader. That's why we hired Dave Midrich, who ran the Tesla Gigafactory in Nevada. We remain incredibly excited about the future. We'll be holding our third annual Plug Power Symposium on October 14th. We're moving to a virtual event because of the recent uptick in COVID cases. You'll be able to sign up online next week, and we expect to have an in-person event in the spring once this pandemic recedes to show off our facility in Rochester. I was there yesterday. It's just great. Finally, we're operating now with 4 general managers for our different businesses. Keith Schmidt for new markets. That includes stationary and on-road vehicles. Keith's done a marvelous job closing out the HYVIA JV. And as you know, Keith has been Plug COO for 7 years. Ole Hoffman running our electrolyzer business. Ole worked at Air Liquide for 29 years and ran their U.S. hydrogen business for many, many years. Jose Crespo has led our sales efforts for 6 years and is now the head of our material handling business. And Sanjay Shrestha, with a long career in renewable energy, is running our energy business. Quarterly, I'll ask one of them to join the call. You know, they're focused on building the business, and I'm sure the analysts would like to speak with them. In this quarter, I've asked Sanjay to join me, as well as our CFO, Paul Middleton. We're ready now to take questions.
Thank you. At this time, we will be conducting a question and answer session. If you'd like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you'd like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. Our first question comes from Colin Rusch with Oppenheimer. Please proceed with your question.
Thanks so much. Guys, well done on the revenue guide higher here. But what I would love to understand in more detail is what's going on with your customers in terms of the growth trajectory into 22 and beyond. What sort of foundation are you laying at this point? What can you point to in terms of customer activity, conversion rates, and order size that would give us some comfort on the continued growth as we go forward?
Yeah. So, Colin, as you know, we've committed to. First, let me take a step back. I'm sitting here, and it's beginning of August, and we have the $500 million in-house for shipping this year. That's really unprecedented. For next year, we feel incredibly comfortable with the $750 million. I expect the electrolyzer business to be $150 million of that. I expect material handling this year will be $457 million, and we expect that number to go up and continue to grow. And the energy business and new markets have great potential. Before this call, Sanjay and I had a long talk about whether we should be up in guidance for 2022 today. We have this symposium on October 14th, and I think you'll see us lay out a new plan and some new insight into how the business can be significantly bigger in 2021 and 2022 and 2024.
Okay, thanks so much for that. And then the follow-up is really around the Class 6 truck and, the progress that you've made on that in terms of, finishing up designs, qualification of suppliers, and your ability to start building some of those things with your partners.
Yeah, Colin, we expect things are progressing well. Unfortunately, we're not having the in-person event where we're going to have some vehicles there, both for the light commercial vehicles and the Class 6 to show off. I've seen the vehicle that we've done for our JV. We're remaining in line that we will do 10 significant pilots next year for on-road vehicles. And I think probably more important, we are in discussions about the model for heavy-duty vehicle trucks. And I think, I didn't mention that in my opening remarks, but I think you'll be certainly hearing a lot more about that in the coming 6 months, and certainly at the Plug Power Symposium.
Perfect. Thanks so much, guys.
Good talking to you, Colin.
Thank you. Our next question comes from P.J. Juvekar with Citi. Please proceed with your question.
Yes, hi. Good morning. Good to be on your call.
Good afternoon, PJ. So I know we usually do this in the morning. It's wonderful to talk to you.
Good to talk to you, Andy. I understand that you had to absorb some hydrogen cost for your customers this quarter. But as you build out your hydrogen network, would you have cost pass-throughs built into your future contracts?
I will let Sanjay take that. Sanjay, I know you run this and do this every day.
Sure. I'm happy to do that, Andy. Thank you. Hey, PJ, how are you? So PJ, a couple of points, right? Our goal is to really think about making green hydrogen as economical as gray hydrogen, right? Number one. Number two, the way we're building this green hydrogen generation network, we're really thinking about how can you tackle force majeure like this so that another plant shut down because of the force majeure disruption in the industry is not as big of an event for the entire hydrogen industry as well as for Plug Power and our customers, right? So the way we're looking at it, our goal is to be as transparent as we can, but we're really not looking to take a view, frankly, of being opportunistic, if you would, for a lack of a better word. If there is a disruption in the industry, this is the time to hike up the price, deal with situation like that. Look, our goal is to make sure that we keep driving the cost and price of hydrogen down so more and more application opens up, right? So that's the approach we're taking. That's how we think about it. And really, we're not looking to sort of make sure that we're maximizing the profit opportunity. Of course, we want to make sure we have the right return profile built into this, right? And again, one of the key things that we have said it in the past, we are really looking to make sure that our end customers get green hydrogen at the same price that they're paying for gray hydrogen today. And more importantly, we're focusing about really build the ecosystem, more apps come online where hydrogen becomes more and more ubiquitous and folks aren't concerned about having apps like long road, middle mile vehicle and things along those lines. That's how we think about this, PJ.
Great, Sanjay. Thank you. And, as you get closer to building out your new hydrogen network, cost of construction is going up everywhere. So do you have a good handle on your building costs as well as your green power costs? And given all that, are you still sticking to your gross margin targets for hydrogen fuel that you've highlighted before? Thank you.
Good. Sanjay, you want to take that one too?
Sure, Andy. Happy to do that. So, PJ, sure. Let me break that into two parts, right? First part of the question is the power component. Absolutely yes, right? So that there is no change to that. If anything, we're continuously looking to see, where else can we lock in more location, where there is an attractive renewable sources as well as expansion potential, and which is why we're working with a lot of different partners on that front. Now, you bring up an excellent point, which is commodity prices are up, right? And are we concerned about potentially EPC costs being maybe marginally higher than what we thought? Look, when you're doing big projects like this, there's always going to be some pluses and minuses, right? But at this point in time, given that the biggest component of the cost is variable cost, and that's electricity, right? CapEx is still a relatively small component when you think about the total cost per kilogram of green hydrogen molecule, right? So even if there were to be some escalation, given what's happening to the commodity prices, labor prices, we really don't see any changes to what we've talked about from our cost target as well as our margin targets.
Great. Thank you. I'll pass along.
Thank you, PJ.
Thank you. Our next question comes from James West with Evercore ISI. Please proceed with your question.
Hey, good afternoon, guys.
Hey, James. How are you today?
I'm doing well, Andy. So, Andy, your increased confidence in raising guidance, and then it sounds like increased confidence in next year as well. Is that driven more by your base, materials handling business, just gaining some more initial momentum, or are you getting momentum in some of the other areas you've been targeting, like data centers?
Yeah. So, let me tell you. So, James, yes, and yes. But
okay.
Let me just give you, a good deal of my increased confidence for next year has to do with the continuous performance of our material handling business, which I think it's probably fair to say will continue to grow at the rates we've seen before. We have now 5 pedestal customers. When I started talking about pedestal customers 2 years ago, we had 2. And, as Jose Crespo pointed out to me, we've already hit the number of pedestal customers we expected in 2024 this year. I mean, that's a huge accomplishment. Now, the electrolyzer business, I believe will be at least $150 million next year. And just to give you a feel for that, I spent 7 to 10 days in Europe with Ole Hoffelmann and David Bowe, who run our electrolyzer business. And just in those 7 to 10 days, we booked $30 million worth of business for next year. So, that just gives you a feel. And we're working on some rather huge, large projects. One of the advantage we have and James versus other folks is we actually have a factory that can make stacks at that pace, which is needed for that market. It provides us a unique advantage, I think, versus the competition. And, I look at the funnels and, I didn't even touch on the stationary market. And in the stationary market, we have activities in data centers. First units will be getting deployed now. What we also found 2 other markets, which the first one I never really thought about, which is counterintuitive to me, but we're seeing for EVs that folks are having difficulty bringing the electricity to the grid. And we actually probably next year could just do $25 to $30 million in business providing stationary products to power EV EV vehicles, which is, in some ways kind of counterintuitive. And, our present customers in material handling at the end of this year will be at 165 sites. They have hydrogen on site. And I can tell you, because of some of the issues with siting diesel, some of the issues with, in California, there's limits to how long you can run the diesel engines. we actually see and been talking to our 5 big customers about, deploying stationary power products to back up their buildings. So, and those applications, they're low-hanging fruits because we have the hydrogen there.
Right. Makes sense. Well, congratulations on that. Maybe a left follow-up for me on your green hydrogen. As you bring production online, how should we think about the pace of takeoff agreements? Should those be coming on kind of consistently as you start up the production? Should we hear about them well before? And I guess, do you think you'll basically have sold most of your hydrogen before it actually comes online?
Sanjay, I will let you take that one.
Yeah. So, hey, James, how are you? So, great question, right? This is something, obviously, we're spending a lot of time on now because, our initial priority was to lock in the sites, right renewable sources, cost of green hydrogen molecule. That's been our focus, right? How do you make sure you get these things done on time, on budget, stay with the schedule, right? Now that part, as Andy mentioned, right, it's now becoming a lot more reality. We just broke ground in Georgia plant, which will actually be the gas plant by the end of this year, the first green hydrogen gas plant, and then 15-ton liquid plant by the summer of next year. So, we obviously have a lot of those discussions going on, right? And we look forward to providing a lot more update, obviously, at our upcoming symposium. So the way we're thinking about this is as follows, right? Our goal is to really make sure that our customers are getting the benefit of this green hydrogen, number one. Number two, our goal is to expand more applications so that the pie becomes bigger. We're not looking to go after the existing pie of the hydrogen market, if you would, right? Our goal is to really make sure that the pie gets bigger. For example, James, right? Material handling consumes 1 kilogram of hydrogen a day. If you have Class 8 truck, that's going to consume 40 kilograms of hydrogen a day. If you have 10,000 Class 8 trucks, you're going to need 400 to 500 tons per day of hydrogen capacity. Today, you have 285 tons per day of liquid hydrogen merchant capacity in the U.S. We're trying to tackle that topic, right, that issue, and not to mention the fact the incremental demand from stationary data center opportunities. So you will see us start to get these plants loaded as we go forward, as these plants are going to start to come online by the summer of next year, in Q4 of next year, Q1 of 2023, and we'll have a lot more to share over the next quarter or two.
Okay, got it. Great. Thanks, Sanjay. Thanks, Andy.
Thanks, James.
Thank you. Our next question comes from Craig Irwin with Roth Capital Partners. Please proceed with your question.
Good evening, and thanks for taking my questions.
Good evening, Craig. How are you?
I'm great. Congratulations on that really nice revenue guide. It's good to see the traction. Andy, I remember many years ago in Albany when you were working on the cost out of your systems, you really did an impeccable job by engineering the product. And then there was a little bit of a, let's just say, technology substitution, technology evolution in there as well. This gigafactory you're going to be building, this is more innovation on the manufacturing side, not just on the technology. So it's a more holistic approach. Can you maybe help us understand the potential cost improvement on stack production out of this facility, and electrolyzer production, I should say too? Are we looking at very material cost down in overall system economics? Is this something that you see as key to unlocking the longer term margins of the company?
Craig, I think you hit it on the head. I mean, and I'm going to say, I brought Dave in from Tesla to automate that factory and help us significantly drive down costs. When I look at the cost of MEAs, when I look at the fact that we're moving to metal stamped plates for our stacks, when I look at we're changing the whole manufacturing process for how you manufacture electrolyzers by going from from a wet to a dry bill, we see step changes in cost. So I think before we do other work, I think you're probably thinking about costs on a typical frac can drop 20%. But there's still so much more. We've been to our Latham factory, Craig, One of the areas is, I kind of opened this call and I talked about that, improving our manufacturing, both at the Gigafactory and in Latham. We're looking at all sorts of tracing systems to make sure we're on top of everything. Not only will it drive down our material costs, it'll make our quality better, our service better, and predictability better. I was there at the Gigafactory yesterday, watching the construction process, and I think it's going to be a game changer for our costs.
Excellent. So my follow-up question is around the heavy-duty market, right? Trucks and buses, or I guess medium-duty as well. There seems to be a misperception out there that this market is several years away. I know you've been talking about this now, I guess, for close to 2 years, and it's unusual for you to talk about something unless there's material action. Can you maybe scope out for us? I know you're not ready to talk about individual customers or commitments on the part of customers, but can you maybe scope out for us roughly, how many stacks you've supplied for potential customers to evaluate either as engineering bench systems or to build test vehicles or prototypes that would be evaluated to put together business plans? Are we talking about single digits, or is there potentially, a much wider experience base that's already been developed?
Yeah, and Craig, and I would say the experience is wider. And look, we've already built, we're building vehicles at our HYVIA JV. I mean, and these are you look at the Master Van product and you look at it, it's the real deal. And we do have. Let me try to make sure I phrase it right.